So credit, it's one of the most daunting things and the most mysterious. So we're going to talk about the good, the bad, and the beauty of having credit. All right, if I can get this to work. Nope. Okay, there we go. So what is credit? Credit is your ability to obtain goods and services with the promise that you will eventually pay for them. So I like to use a scenario about my friend Vinny. Do you guys know Vinny? He's out at the street corner. He'll loan you some money. But when you go to Vinny and you ask him for $100, he's going to tell you, all right, here's your $100. In 2 weeks, I need you to bring me the $100 plus $100 in interest. In 2 weeks, you show up and you give Vinny the money. No problem. A month goes by and you go back to Vinny and you're like, hey, Vinny, this time I need to borrow $500. He's like, okay, you paid on time last time. Here's $500. And in a month, when you return that money, I need another $100 in interest. Everything works out perfect. A year goes by, you go back to Vinny and you're like, hey, Vinny, I need to borrow $1,000 this time. He's like, no problem. You're a good returning customer. Here's the $1,000. In a month, when you bring it back, I just need another $100 in interest. That's exactly how banks work. The more that you pay on time and that they can trust you, the more they're going to loan to you and the lower the interest rate's going to go. So what is the difference between your credit report and your credit score? The credit report is all the information about you. It has your name, it has your social security number, it has your addresses. Typically, it has your address for the last 10 years. So if you've moved around a lot, it may have several addresses on there. It will also list all of your creditors. It will list the ones first that are in a negative situation. So if there's collections or if you're behind on a creditor, those are going to be listed first. Then it will list all the things that are in good standing. So maybe you have a credit card that's current and your mortgage is current or your car payment, all of those will be second. Then finally, at the end, we'll have any kind of court records. So if you file bankruptcy, if you've had a repossession, if you've had a foreclosure, those typically come last. So the credit bureaus take that information and they assign a number to it. And that's how they come up with your score. So typically when you pull your credit report, you will not get a score. You will just get the information. There are 3 credit bureaus, Experian, Equifax, and TransUnion. We recommend you using annualcreditreport.com to pull your credit report. You don't have to worry about giving your information. It's absolutely free. That doesn't make you put in your bank card and charge you $1 today and then $30 next month. It doesn't work that way. It's absolutely free. But it's only free to get one report from each of the bureau once a year. So what we recommend is maybe pulling Experian in January, maybe Equifax in May, maybe TransUnion in September. That way you could keep track of what's going on your credit report throughout the year. You could go pull all 3 of them today if you wanted to for free, but you have to wait 13 months to get them free again. You can also go back in and pay for them. After the free one, there is a fee to pull it again. And I think it's $9.95. I don't think they've changed it recently. But if you want to pull all 3, they'll give you a little bit of discount. I think it's like $25. Now, right now, they are giving them away free every week until May 1st. So we only have a couple of weeks left because of COVID. And then after May 1st, hopefully they'll extend it. But we've had so many people that have had their information compromised because of COVID that they were allowing you to pull it for free every single week. But we'll see if they extend that or not. So each bureau has its own scoring system. Equifax ranges from 300 to 850, Experian 340 to 820, and TransUnion 150 to 934. So you can see that they're similar, but they're not exactly the same. So it's not like you could get a score from each of the bureau and then add them together and then divide by 3 to get an average. It's just not going to work out because of TransUnion. So again, their scores are irrelevant. I see a lot of people that get a score from a third party, but it's not the FICO score. And that is the score you're looking for, is that FICO score. There is Credit Karma and Credit Sesame. These are really good tools to use. Both of them will allow you to pull your TransUnion at any time. I think it's just once a month. And then Credit Sesame is owned by Experian, and Credit Karma's Equifax, I think. So you also get to pull theirs as well. Again, it's for free, and they will give you a score, but it is not your FICO score. I think the only credit card company right now that's providing your FICO score is Discover. If you have a Discover card on your statement, it will show your FICO score. But other than that, as far as I know, you're not getting your FICO score. I'm sorry, I just realized I want this to be as interactive as possible. So if you have any questions at any time, please do not hesitate to stop me and ask a question. Why is it important for you to have a good score? Well, it affects your ability to buy a house, get a job, your insurance premiums, and it gets you better rates on loans. Most people don't know that their insurance premium, especially for their car, is based, it takes in consideration your credit score. If you have a low credit score, they consider you to be a risk. And so your premium will go up if your credit score goes down. And of course, we're all here to learn about how to buy a house. And so that is a huge factor, what interest rates you're going to get, how much you're going to pay for that house by having a low credit score. So this is how FICO has told us they come up with their score. 35% of your score is based on your payment history. Are you paying on time?
Latricia?
Yes.
Is any insurance company better than the other in obtaining good credit report?
No, not from insurance companies. No. You want your credit. Right. Are you talking about like rates, like if you have a lower credit score, which one would be better?
Yeah, in a sense. I mean, you were saying that the fact that paying your insurance on your auto, it affects your credit score, right?
No, your credit score affects how much you pay for car insurance.
Okay. I misunderstood you.
Yeah, so if somebody has like a 720 credit score, they're going to pay less for their car insurance than somebody who has a 500. Because that person who has the 500 credit score, they're considering them to be a risk. And so that's why they're going to charge you more.
On that credit score. Right. You're right. Okay. Thank you.
You're welcome.
Latricia, there's a question in the chat.
Okay.
It's from Emily, and it says, what is the difference between the three agencies? Do certain things influence a certain agency score? Basically, why are there three?
Well, there's three because it's still old-fashioned. Experian is located in Atlanta. TransUnion is located in Dallas, Texas. And no, Equifax is in Atlanta. Experian is in Boston. So because it depends on where you lived, that information would get reported to one bureau. And then that bureau would send the information to the other two. And so sometimes there can be a little bit of a time gap. Now, if you paid it on time and it's reported to Experian that you paid on time, the other two, even if it takes them 30 days to get that information, it will still show that it was paid on time. But that's basically why there's three, because we needed to cover the whole country. Do we really need to do that now? Probably not, because since everything's electronic anyway, but there still are some folks that report via paper. And so they probably still need to have semi-local credit bureaus. As far as their scoring system are, again, kind of all over the place, but it really doesn't matter because it's how FICO is evaluating your credit. And that's what we're talking about now. That's what the score that you will really need to know is what your FICO score is. Unfortunately, you can't just go and pull your FICO score. You actually have to apply for some credit in order to get your FICO score. I hope that answered your question. So, okay, great. So if we go back to this chart, 35% is based on your payment history. Are you paying on time or are you not paying on time? 30% of your score is based on how much debt you already have. So if you have $100,000 in student loans and you have a $35,000 auto loan and you have $15,000 in credit card debt, but you only make $30,000 a year, that's really going to put your debt to income ratio out of whack. And that's going to affect that outstanding debt portion of your credit score. 15% is how long you've had credit. Now I have a credit card that I had since college, and you can see I have gray hair. So that was a long time ago, but I keep that card open so that I have this history. If I close that card down, then the longest credit account I have is probably my mortgage at about 15 years. So my score would drop because I'd lose all that history. Now, if that card had a bad history, if I was always late on it or I overextended myself, then I'd probably be better off closing that card down and just get it away from me. But because it's still in good standing, I use it a couple times a year and pay it off. It keeps my score up. 10% of your score is also based on inquiries. Are you pulling your credit report? Are you applying for credit? Those affect your score. You can pull your credit report anytime you want to. You can come to our office. We can pull your credit report. It does not affect your score. You're not applying for credit. All you're doing is getting information. If you apply for credit, then it will drop your score approximately 10 points every time you apply for credit. Now, depending on how often you're applying, it could take you a while to get those points back. But if you just apply, maybe just this year you applied for one credit card, you're going to recover those points pretty quickly. You won't lose them for a very long. But if you apply for 5 credit cards and a car loan, your score is going to be suppressed for a little while. It's going to take you a little bit to get those points back. We see this a lot at Christmas time where someone might go shopping, let's say at Walmart, and they say, hey, if you apply for this card, you can save 10%. You apply for a Walmart credit card, but let's say you don't even get the credit. Your score has been hit and it's going to drop about 10 points. And then let's say you go to Target and they say, hey, if you apply for the red card, you could get 15% off. And you apply, that's another 10 points. Then you go to the mall, in a store in the mall, maybe Belk. It tells you the same thing. You can save 20% if you apply for the credit card. That's another 10 points. So in one day, you've lost 30 points. And again, it's going to take you several months to get those 30 points back. So just be mindful of how often that you're applying for credit. Then the final 10% of your score is based on the type of credit you have. Creditors like to see both revolving and installment loans. So a revolving account is a credit card. It revolves every month, the balance changes. Where an installment loan would be a car loan, maybe a personal loan, a mortgage, where you know it's a set payment every single month. And they want to see both. So a lot of people, they think, well, if I pay off my car loan, my score will go up because that's less debt that I have, right? If you don't have another installment loan on your credit report, it's actually going to drop your score. Because creditors, again, they don't have a history to judge you on how you're going to pay back your loans. Doesn't seem fair, but that's how it works. I didn't make the rules. I just report them, that's all. So these are the FICO scores. It ranges between 850 and 300. And there are plenty of people like you and I that have perfect credit scores. I don't have a perfect credit score, but there are people out there that do have an 850. And it's because they know how they pay their payments on time. They have their debt to income ratio just right. They're not applying for credit all the time. They know how to play the game to get that perfect score. We as a nation have actually done pretty well, and we're averaging about 700 right now, where for many years we were down around 650, 600. So I'm not sure what we're doing, but I think we're getting better educated on how to use credit. And so we're, as a nation, we're creeping up there. I will tell you again, you have to use credit in order to have a credit score. So I always like to talk about Bill Gates and what his credit score might be. Again, you might think he's a millionaire, he has all the money, he can buy anything he wants to, but he doesn't have a credit score because he doesn't use credit. Now, if you went into a bank and wanted to borrow $1 million, do you think they'd say, no, well, we're not going to loan it to you because you don't have a credit score? Of course not. They're going to loan it to him because they know he has the cash to pay it back. But you and I we might not even be able to open up a checking account if we don't have a credit score. We might have to have a cosigner on our checking account just to open that up. So it really is important. I know I talk to a lot of people and they tell me, oh, I don't want to mess with credit. I'm going to pay everything in cash. And that's fine if you can do it. But if it comes around where you need to buy a car with a car loan, or you want to buy a house, you're going to have some credit. Come on, there we go. So let's talk about purchasing a car. And we're going to
Latricia,
Yep.
Sorry, there are a couple questions in the chat.
Great.
I was trying to wait for you to get through with that slide. The first one from Yolanda, she says, I paid off all of my credit cards, and as you said, my score dropped. Do you have recommendations for credit cards?
With credit cards, you can just use them and pay them off at the end of the month, or maybe even sometimes, I mean, I hate to tell you to get interest, but they want to make some money off of you, and that is going to increase your score. So if you could just carry a small balance over a month period, you'll start to see your score to go back up. But just because they're paid off, again, you want to use them, or they might get closed, or something else might happen. So continue to use them, but just make sure you can pay it off.
Okay. There's another question from Jenny. It says, I don't have any debt. I realized I didn't have any credit either, so I applied for 2 cards, a store card and a Visa. I got both and my score dropped over 50 points. I have only used the store card and I paid it off. Should I use the Visa now? What, or does it matter at this point?
Again, yes, I would say to, use it a little bit. Again, maybe just use it for gas and then pay it off at the end of the month. You can go in and pay off your credit. You don't have credit cards at any time. You don't have to wait for the statement. You don't have to wait for them to add interest to it. You can just go ahead and pay it off, but you do need to use it. Typically, so I would see that your score might drop the month or two that when you got the credit card, because they don't want you going out and getting a bunch of credit at one time. So they're going to slow that down a little bit so that you don't continue to go out and try to get more and more credit. But again, typically it's going to bounce right back. I just got into this really bad habit of weighing myself every day. I don't know why I do it. I just do. And I can't even tell you what the scale says because I don't even look at it, but it's just part of my routine. I brush my teeth, I get on the scale, I get in the shower. And one of the reasons why it's a bad habit is because it changes every day, right? You're never the same weight every day. It could be 4 pounds off any given time. It's the same with your credit score. If you checked it every single day, it would drive you crazy because it fluctuates every single day. So again, if you know kind of the ballpark where it's at, that's really all that matters. Any other questions?
Yes. Tanya wanted to know if a furniture account like a one set up with installments, that would count on your credit?
Typically, no. A lot of those kind of buy here, pay here places, like rent to own, they do not. If it's Ashley Furniture or Rooms to Go, yes, because they actually get your credit through Capital One in most cases. But if it's like Babcock Furniture or a rent to own place, they do not report to the credit bureau, so it does not show on any credit report.
Okay, we have another question from Tanya. She asks, what about secure credit cards?
Secured credit cards, we're going to talk a little bit about that going forward, but yes, those are a good thing. And I'm going to talk about that in just a minute. So I'm not going to talk about the full thing, but those are a good place to start.
And then Jenny asked, on her credit report, I can see an old account has closed itself because it had not been used. I didn't owe anything on that account. Would it be beneficial to reopen it?
If you can reopen it, yeah, that would be a good idea. Because again, you get that longevity, you have that whole history. I don't know if they'll reopen it. They probably will just give you a new account. Typically that's what they do. But if they could reopen that old account, that would be great.
Okay, that's all the questions.
Okay. So let's talk about installment loans. So we know going in how much we're going to borrow. We're going to borrow $25,000. And depending on what your credit score is, you're going to pay a different interest rate. But we know exactly how much we're going to pay every single month for 60 months or 5 years. So if we have a score of 619 or below, we're probably going to have to go to a buy here, pay here place. 16.22% is what Capital One charges on their high interest auto loans. Where if you have an excellent credit score, you're looking at 3% or even less. These numbers are actually from last year. And so I know at my credit union for a new car, you're looking at 1.9% interest, which is crazy. It is crazy low. But in this scenario, let's say it's 311. The difference of having that higher credit score means that you're going to pay $161 less a month than the person that has a 619. But over the 5-year period, it means that you're going to pay $12,660 less in interest. That's a lot of money. I mean, that's almost half of what the card costs that you're going to pay extra in interest. So what we recommend is just because you start out at 6.22% doesn't mean you have to stay there. Once you've had the car for a year and you've paid on time, your score should be increasing. And so you should refinance. And not refinance with where you bought it, but go to a bank or a credit union. I highly recommend credit unions. They always have the best interest rates, and get the loan from them. That way you can save a ton of money. Even if you refinanced it for another 5 years, so you're actually paying on this car for 6 years instead of 5, you're still going to save a ton of money going from 6.22% even to 5% or 10%, just down to 10% will save you almost $10,000. So just be mindful of where your credit score is at. And just because you start somewhere doesn't mean you have to stay there. So let's look at a mortgage. And let's say we're going to get a mortgage for $180,000. Again, credit scores are a little bit lower than this right now. But if we have a 620, you do have to have a minimum of a 620. And let's say the interest rate is 5.19, as opposed to having an excellent credit score where it's 3.6. Again, they're lower right now. I just didn't adjust these from last year. The difference is $147 a month, or over the 30-year period, it's an additional $63,000 in extra interest that you're paying just because of your credit score. Typically, if you can save 1% in interest, we recommend refinancing. In in my husband, in my case, when we first bought our home, we got our interest rate at 8%, which was the going rate. But when interest rates started dropping, we were able to go from an 8 to a 3.5% interest, and go from a 30-year mortgage to a 15-year mortgage, and we still saved $100 a month. It's amazing what will happen when your credit score goes up. You can really save a lot of money by refinancing. So again, those are installment loans. Let's talk about credit cards. That's how they use compounding interest.
Here's a quick question.
Okay.
From Trisha in the chat, is it better for your credit score to pay off early or to refinance?
I mean, it's going to save you money if you pay off early. Again, if you have no other installment loan on your credit report, then you might want to refinance. It just, again, it depends on the individual and what their situation is. That's a hard one to say for sure what is the better situation.
From Andrew in the chat, he says, I have excellent credit payment with a high APR company. As my credit goes up, should I lose that good history?
Okay, so a high interest rate, is it on an installment loan?
Yes.
Okay. Yes. Again, I think refinancing it with somebody else with a much lower interest rate, I'd rather save the cash and have a lower credit score, which is going to recover as long as you're paying on time. Your score is going to recover. But I would rather have you save the money with a lower interest rate than keep the high interest rate loan just to keep the history. Because again, if it's an installment loan, once it's paid off, the history goes away anyway. It's just credit cards that will stay on there for as long as the card stays open, you have that whole history.
He said, thank you.
Okay. So here's compounding interest. So let's say I have a credit card and it has a $10,000 limit. And I have a pretty good credit score, so it has a 17% interest rate. Credit cards can go up to about 35%. If it goes over that, it goes into the predatory, but major credit cards go up to 35%. If I go below this whole $10,000, let's see, I'm going to go on a cruise, I'm going to drink champagne, I'm going to buy some diamond earrings, I'm going to have a good time. When I come back home, I get my statement, it's going to show my minimum payment is $142. Okay, I can afford that. So they take the $10,000 and they subtract my $142 payment, and my new balance is now $9,858, right? No, they got to add back in the interest. So they take my new balance and they multiply it by 1.7%, and it comes up with $141 for that month's worth of interest. So my $142 payment only reduced the debt by $1. Wow, how does that work? That doesn't seem right. After 2 payments, I'll reduce my amount by $2. By 12 payments, 1 whole year of making those payments of $142, I'll only bring down the balance by $5. Now wait, that doesn't make sense. 1 month is $1, 2 months is $2. Why is 12 months only $5? Because it's compounding, it's growing on itself. It keeps getting bigger and bigger. After 10 years, I'll bring it down by $104. After 20 years, I'll only bring that balance down by $665. And that's as long as I pay it on time. Because if I'm late, or if I'm late, they're going to charge me a late fee, and they can increase my interest rate because I have actually not stuck to the agreement and I paid late. It'll take me 36 years to pay off that $10,000. I'll give Citibank $61,000 So $51,000 in interest for that $10,000 loan. Now, had I paid attention to the truth in lending statement, it would have showed if I increased my payment to $150, just $8 more a month, I could have paid it off in 17 years and given them $30,000. So always be mindful on your credit card statement. It's going to be in a big, bold, black box, and it's called your truth in lending statement. And it will tell you what the minimal should be to pay that off in a short period of time. We also don't recommend that you charge anything that you can't pay off in 30 days. So I could go ahead and charge that $10,000, but if I couldn't pay that off in 3 months, then I shouldn't be charging it. But anything more than that, I'm going to pay way too much in interest. So let's talk about if you don't have credit, where do you begin? And here's where the secured credit card comes in. So this is where you give a bank or credit union some money, typically $300, $500. They put that money in a savings account and they give you this credit card. You go and use it like any other credit card. You make monthly payments, you pay towards the debt. If you don't pay it off, you get interest. Everything's the same. But if you skip town and don't pay it off, they have that money from the savings account that will cover it. Now, after having a secured credit card for a year, you can ask them to convert it to a traditional credit card. And then you get all that money back from the savings account plus interest. And then you have a regular traditional credit card. So that's a good place to start. You might start with a store credit card, again, like a Target, Walmart. Just don't apply for all of them all in one day, but they typically take a lower credit score. You might want to try getting a small bank loan. This is typically like a $500 loan that you would get from your local bank or credit union. And you don't go spend that money. You put that money in a savings account and set up automatic payments so that it pays itself back. And then at the end, you just pay whatever is left in interest. That will boost your credit score very quickly. You can also try to apply for a traditional credit card. Capital One and Discover both have what they call their starter credit card. Again, it's not a great credit card. It has a $500 limit. It has a 30% interest rate. It's not a great one, but it is someplace to start.
Hello, ma'am.
Uh-huh.
I'm sorry, can you hear me?
I sure can.
I started with Chime with their secure card, and it
Yep.
reports to the 3 bureaus.
Yes. And are you having success with that?
Yes, I
Okay.
pay it on time, and what it is, when I get paid from my job, well, when I get paid or I deposit money into my regular Chime card, I
Uh-huh.
have it moved to the credit building,
Yep.
which is the secure card, and it
Uh-huh.
holds it. So I just spend what I put on there, and at the end of the month, they automatically pay it for me. So I don't have to worry about, I forgot whatever automatically come out.
Yep. There's a couple of companies. Chime is probably the most, the biggest one, but there are a couple of companies that are doing that. I do have to ask now, when Chime first started, they weren't charging any fees. Do they charge you any fees?
There's no fees, ma'am.
Okay, good. I'm glad to hear that, because again, some of them are charging fees, but Chime wasn't, and I just want to make sure they still were not. Great, thank you. I appreciate that. So
There are a couple questions.
okay,
From Gregory, he says his credit score took a dive from a hospital count going into collections. He wants to know, collections says the negative item will be removed with payment. Is that during or upon completion of total payment?
yes, you have to pay that off. So either with monthly installment payments or some kind of settlement offer, it will be on your credit report until that is paid in full. And anytime you have anything in collections, it doesn't matter if it's $1 or if it's $5,000. If it is in collections, your score will be suppressed.
And Andrew asked, which is better, a secured credit card or the discovery option?
Either one is fine. If they report the same way to the credit bureaus, does not matter. All right, so I know you guys have seen these signs around town. Sometimes they're blue, but most of them I see are red like this. And there will be a dollar amount, and depending on what part of town you're in, that dollar amount could be different. Sometimes I see $99, I've seen $100, just it's all over the place. They can't do anything for you that you can't do for yourself for free. And typically what they are doing is disputing the debt. Well, the credit bureaus have caught on to what these companies are doing. And so in the past, when an account was disputed, they would take it off your credit report. And then when they found it was yours, they would put it back on. Or if it wasn't yours, it would stay off. Now it stays on your report until they can determine it's not your debt or it's fraudulent or whatever. If it is actually a fraudulent account, you will have to have a police report to back up that it's fraud. So just also be mindful of that. If you're trying to dispute something, you have to have evidence, typically in the form of a police report, to show that it is not your account and it's fraudulent. But really, do not waste your money. Like this one, it starts out at $250, but then they charge you $99 every month after that. Again, to do basically nothing. They're just ripping you off. They're not doing anything that's important. So if you do find yourself in a situation where you're a little over your head in debt, there's a couple of things that you might want to do to tackle it. You may want to try paying off a low balance credit card. Maybe you have a credit card that just has a couple $100 on it, and you could pay that off. And then whatever you were sending them, you can send that to your next credit card. It's called the snowball effect. So as you pay credit cards off, you don't continue making minimal payments, but you add what you took from whatever the card was that got paid off, you add that to the next card. So if they were all $20, when one got paid off, then the second one would get $40 a month. And when that got paid off, then you would have $60 a month going to your third credit card. That way it gets paid off quicker. You may also want to pay off a high interest rate credit card. So maybe all your credit cards are at 10%, but you have one that's 35%. It's probably the best idea is to get that 35% paid off as quickly as you possibly can. It may also be an important credit card. Maybe it's one you use for travel or for health insurance, Care Credit. A lot of people use their Care Credit card to pay medical expenses. And so that one you need to keep at a zero balance. You could try a debt consolidation through a bank or credit union. You can also use a debt management plan through our organization. You can also negotiate and pay it off. So typically, again, if it's in collections, we recommend that you negotiate a discounted payoff. If the credit card is still active, if you negotiate less than full balance, they're going to close down your credit card. So we don't recommend you do that with an active credit card, but only things that are in collections. There are no quick fixes. So if somebody tells you, oh, we can increase your credit score by 100 points in the next 30 days, that is a lie. It doesn't happen that way. It is not a quick fix. Use your credit wisely. Make sure you, again, paying on time and that you're paying things off. Pay your bills on time every time. That's our motto here. And keep the balances between 30 and 50% of the limit. So let's say you have a credit card that has $1,000 limit. You want to keep that balance between $300 and $500 at any given time. Again, paying it off as soon as you can, but you really don't want to go over that 50% mark because that will lower your credit score. Now, let's say you go to Disney World and you spend all $1,000 that month, but you pay half of it off one month and half of it off the next month. That's fine. It will not affect your score. But if you carry that $1,000 balance over a couple of months, your score will start to drop fast. So here's where we're located. We're in Eastgate Center. As you can see, I'm not there. I'm on my sun porch. We haven't been working from the office for several months. We're hoping to get back there soon. But you can always give us a call if you have any questions or have any concerns about credit. or just budgeting. We do budget counseling as well. Does anybody have any other questions? I was trying to go fast, so we had plenty of time.
There is a question in the chat from
Okay.
Michael. He says, do collection companies give discounts for paying off lump sum, or is it better to make payments towards things like that?
Both. A lot of collection agencies now, I see them making installments. So they might negotiate, let's say you owe $1,000 and you negotiate that you'll pay back 700. So a lot of them are setting up payment plan with that. It's just going to be on your report longer. If you can get it down to maybe say, I can pay $500 in cash today, that's probably going to be a better solution than string it out over several months to pay that $750 off. But again, it just depends on your situation and what's going to work best for you.
And Andrew asked in the chat, what are the hours for the consumer credit counseling service?
So right now, our client support, the phone is open from 8 to 5. We do have evening appointments. We still work kind of late into the evening, but our client support phone does get turned off after 5 o'clock.
And someone asked, is the service free?
So we do charge a fee to do a credit report review. So if you just want to review your credit report, there is a fee. It is a sliding scale. The maximum fee we charge is $25. If you're looking for a debt management plan where we go through a budget and we look at all your debt to try to see if do kind of a consolidation, there is no fee for that. If you do just budget counseling, there's no fee for that as well.
Are there any other questions for Latricia? Yes, Andrew, can consumer credit help repair my credit report?
I hate to use credit repair because so many times we get lumped into this credit repair group, which we don't do. So depending on what's on there, like if you need help with dispute letters or cease and desist type stuff, yes, we can help you do that. If paying back your debt is your goal, then we can put you on a debt management plan, or again, just give you the advice that you need so that you can take care of it yourself.